Hey, what is up you guys? Welcome to the channel. Today we talk all about index fund investing and why you should consider it. I'm gonna give you 30 reasons why you should love index funds as an investment vehicle. And by the way, those 30 reasons, that's an article that I found by Paul Merriman, which I felt absolutely compelled to share with you guys. I think that's gonna be revolutionary and perhaps change your investing future. Now, if you're somebody that's a beginner investor or that wants to start investing, but you never did, you never spent a dime on the market, welcome home. Today I'm gonna give you a little bit of the basics so you can at least feel your way around how to start investing. And on the other hand, if you're an investor that has already started investing in index funds, I wanna congratulate you, you're doing great, kudos to you, well done. And also, if you're somebody that is on the fence of investing with index funds, but you've heard, let's say, that there is an index funds bubble, I'm here to burst that bubble for you and tell you that there is no such a thing as index fund bubble, and I want to give you the facts. That's my job. I'm going to give you the objective facts so you can make your informed decision of how you should invest. As I always say, before you start investing, you need to understand what you're investing in. So unless you're comfortable, unless you know all the details, don't do anything. And this is the purpose of today's video. So stay tuned until the end of the episode. My goal with this video is to go through some of those points, the key of those 30 points that Paul Merriman has outlined, and give you in layman's terms what they actually mean and why they matter, they should matter to you rather. You know, what is important about those facts about index funds. So I hope you find this useful. I'm gonna jump onto the computer, I'm gonna share my screen so you can follow with me, read through the article and highlight some of the most important points. So an index fund is a type of a mutual fund with a portfolio constructed to one, either match or track the components of a financial market index. Such index, usually a very commonly mentioned example, is the Standard & Poor's 500 index, or in brief, as people refer to it, S&P 500. So an index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. Now, these three characteristics, they're so important to understand the value, or actually the benefit, that index fund investing gives you as an individual investor. There is low portfolio turnover with index funds, and the low portfolio turnover has a number of benefits, which I'm gonna dive into when we get to the article. So without any further ado, let's jump to the article. 30 reasons to fall in love with index funds. I mean, I love the title. And let me share with you why these reasons I believe are absolutely critical to understand. Now, this article is dated back from June of 2014. It's old but gold, as I like to call it. I think it's absolutely amazing because Paul has packed so much information in it. So let's get right into it because there is quite a few I want to cover. Now, let me look at the very first paragraph. The very first point that Paul makes in this article is that despite all the money and effort Wall Street spends trying to promote actively managed funds, very few of them outshine one of the simplest investment vehicles, and that is the index fund. Now, that is absolutely crucial point. What most people don't understand, because they simply don't know, is that indexing is a lot safer. It's, the risk is significantly smaller. Research it further. There is tons of research done out there by Nobel laureates. It's a fact. So moving on with the article, Paul simply lists those important 30 points why you should love the index fund. And I thought that they're due a little bit of explanation because not all of them may speak to you as a beginner investor. And that's what I like to do. I like to break it down for you and highlight the most important ones. So let me first start off with the very first bullet here that says, you won't ever again have to deal with a pushy salesman or broker. That is, if you invest in index funds. And that is very true. That is a very, very important point, because the minute anybody like a banker or investment advisor understands that you're looking into starting to invest or you have some money put aside for investments, the moment they smell that even hint, a note of interest from your side, they're gonna bombard you either with emails, they're gonna keep calling you, they're gonna ask you to meet up with them and just talk about stuff, or even offer you like insurance products, what have you. They're gonna try to sell you anything that they offer so they can get some money out of you. And that's what really index fund really is, kind of like giving you that freedom of not dealing with any of those guys. No disrespect, it's a job like anything else. But for us individual investors, regular people like you and me, who want to put their hard-earned money into working for them and growing their wealth, it's not something that we want to engage in. So moving on with point number 2, your long-term results are likely to put you ahead of 90% of other investors. And that's probably, to me, that's the most important point in this video. It's the most important point in this article. Many people don't know that using index funds, you're actually going to do better than 90% of the people who are investing in general. Point number 3, never again will you have to decide whether to hire or fire a manager. And that's true because I think what the article is hinting here is that it's comparing practically index funds with actively managed funds. And actively managed funds, that's why they're actively managed, because there is a manager or a committee or a number of people that are managing that fund. And if they're not doing a good job, you technically, you can sell that fund or fire those guys who are managing your money. So you don't have to do that with passive index fund investing, because it's an index, it's a computerized mechanism which follows the index. Bullet number 4, you don't have to monitor a fund manager's performance. It relates to the previous point. Again, if there is no human that's managing the fund in the index fund, then there's nothing to worry about a human's performance or a human's kind of take on what's happening based on current events. Point number 5, I don't have to fall in and fall out of love with any individual stock. That's also a crucial point, because most of the times when people buy individual stocks, they buy it, they fall in love with the stock. Let's say Facebook, Google, Amazon, Apple. So the fact that an index fund follows an index, which usually is, let's say, a total US stock market or a total kind of like asset class, let's say a large cap, small cap, etc., you're not falling in love with any individual company, because in the index fund you've got hundreds if not thousands of companies, and that's absolutely crucial. So your expenses, the next point, your expenses will be among the lowest of all funds, leaving more of the portfolio's return for you. If you don't know anything about index funds and kind of passive investing through index funds, one of the biggest advantages is that index funds are low cost. They're probably the lowest cost funds you'll ever get. A typical cost to own something like a S&P 500 index fund in most of the major brokerages, it's somewhere around 0.04%. Now, your capital gain taxes will likely be lower, leaving more for you. That's also very important, because as investors, what we want to be wary of is taxes. How much our money goes into taxes and how we can minimize taxes so we can grow most of what we've made tax-free or minimize that amount. So index funds, they're known to be more tax efficient than actively managed funds, and that's why this is an important point. The next point, the greater diversification in index funds reduces your risk. Now, because index funds, as I mentioned, it usually contains hundreds if not thousands of companies, having that in one fund, almost like a portfolio of all kinds of companies, it reduces the risk versus owning 1 or 2 or 5 companies. Now with index fund, you know exactly what you're getting. You won't have to be aware of any style drift, etc., etc. So I'll skip that point. I think it's not the strongest point in this article, but let's move down. And in here, actually Paul makes a kind of like a mental break, because it's such an overload of information. But I'm going to continue because I'm trying to keep this video kind of short. I'm not sure if I'm going to manage to do that, but I want to highlight some other important points. So Paul continues, index funds are boring. Now, let me repeat that. Index funds are boring. That gives you more time to live your life and less cause for emotional involvement. So the less involved you are, as I mentioned before, the less emotions you put into your investing strategy, the better off you will be. One, you'll make most likely more money because you're not going to make emotional decisions such as emotional buys and emotional sells, but also it will allow you to live your life. You're not going to be every minute, every day checking how is this particular stock that I bought, like Amazon or Facebook, if you bought individual stocks, how are they doing? You're not going to have to read all the news. You don't have to worry about it. Next point, index funds lower portfolio turnover because the invisible expenses of commissions and spreads. Not only that, but because index funds have lower turnover ratio, they're also going to be more tax efficient. And let me just dive a little bit more into that point. So the fact that they have a lower turnover, that means they're not traded as often as other funds. So it could be mutual funds or it could be individual stocks. And the fact that they're not traded as often has those three benefits that I just mentioned. But I want to highlight the taxes because the more fund is traded, the more taxes you're incurring indirectly. The next point, with very few exceptions which you can easily avoid, you won't pay sales commission to buy index funds. That's true. If you're not aware, index funds are very cheap to buy. There's also commission-free ETFs and instruments like that. So do some research on that for some of the index funds that you want to buy. You'll be surprised how cheap they are to own. Now, I'm going to continue scrolling here because I want to get to the point here that when you cast your lot with index funds, you're following the advice of the experts. And I want to highlight that. Indeed, that is the advice of the experts. So when I say, and when you see me on my channel speaking about index funds, passive investing, invest for the long term, that is actually, I'm sharing the advice of the experts. It's not my opinions. I'm giving you the objective things and facts that experts like Warren Buffett are actually mentioning publicly in interviews, but if you don't follow them, you want to know about it. And Warren Buffett has recently announced if his wife outlives him, she'll get a sum of money, the amount isn't disclosed, in index funds. And to be more concrete, there's articles and videos about it. Basically, Warren Buffett says if my wife outlives me, I want her to invest in something like the S&P 500 index fund, 90% of that money to put in the index fund, and 10% in short-term bonds. Now, the next point that I want to stress, we've already talked about it. It says index funds diversify your holdings into virtually every industry. When biotechnology is in the range, you own some of it. When Google, and he says, Horace, if something happens, Google or Apple or Amazon, any of those big tech companies, something falls out of favor, you'll automatically own less of them. So we already talked about that. In the good times, next point, index funds don't flood their managers with torrents of new cash. Why should you care about this? Well, often a manager of popular actively managed fund will be forced to buy more stock in a relatively few favored companies, sometimes driving up the cost of acquiring that stock. With passive index funds, you don't have to worry about it. I think you get the gist of the article. I think the video is getting a little bit too long than I wanted to, but I wanted to share this. Again, I was compelled by reading this article. Even though it's about 5 or 6 years old, everything holds true still today. It's one of the more important articles you can find on sites like this one, because don't forget, there's a lot of media buzz about investing, how you should invest, what you should buy, what is going down, what is going up. But all of this is noise, and it's really hard actually to tune out the noise, because all this noise, what it's made from the mass media, is to make you buy and sell. They want to instill drama, they want to make you panic, but all of that is not good for you. You're not going to win this way. And it's important to weed out this noise from these kinds of sites. Nothing against them, but that's how they make money. So I'm here for you. I'm here to distill that information. So I want to give you some of those nuggets in this format. Hopefully they're useful. And by the way, if this video is kind of long for you, I also have an Instagram account where I post bits of financial wisdom. So if you're more of an infographic person, you can also follow me on Instagram and get some of these nuggets of advice. I think you're going to benefit to keep you focused, laser focused, to get to your financial freedom. Now, if you're somebody that's active on forums like Twitter and other social sites, feel free to share this video with friends. Feel free to tweet it, retweet it, etc. I also have a Twitter account. Check that out as well. I want to conclude this video. I hope you enjoyed it. If you did, again, don't forget to like it, hit the thumbs up, subscribe, share, and I'll talk to you later.